Hey guys, today's Wednesday, March 19th, and we just had the FOMC meeting earlier today. And this was a pretty important meeting because we also got a summary of economic projections update. And basically, we had some new signals that came in for our future analysis. Okay, so basically, let's wait a little bit for folks to join, and I'll get into our discussion. $71 people so far. While we do that, I also remind you that we have launched our Bitcoin intelligence product. This is a new analytics service and platform that brings you all the information you need for understanding Bitcoin. Basically, it delivers macro updates, and it also delivers the on-chain analytics, derivatives, and including the proprietary models that we have developed for Bitcoin internally. We also have plans to add a AI and machine learning component to all the work we have done, especially because we believe there is a lot of valuable signals in the data, but we need the power of AI to combine several signals, and which helps us understand and extract the interactions, the second order, third order terms, and some more complicated and some more complex relationships that might exist in the data. Okay. All right, so let's get into the FOMC. I have some notes here. The first thing, the elephant in the room, was that there was no cuts. This is the second meeting that they offered no cuts. And it was pretty expected because the headline data, especially including the, let me also change my microphone. Yes, especially including the, the unemployment at 4.1%, nothing really worrisome. The way the Fed thinks about these things. Then we had pretty strong job gains, 151,000 jobs gained in February. That shows resilient economy. Then looking at inflation, it was pretty sharply going up month over month. I think we had readings of 0.4, 0.5% increase on a monthly basis in January and February. But it has in December and January, but it has eased in February. And the year-over-year numbers of both CPI and PCE and the core CPI and core PCE, but they've all either stabilized or have come down. So when you take all of this, you realize that the Fed really doesn't have any cover to cut rates. However, our goal is to essentially dig deeper and see what's underneath the data. But there are several signs, several risks to the economy right now, which actually the Fed also mentions and confirms, but they don't react to it yet. One of them is that even though unemployment seems okay, when you look at U6 unemployment data, which is the same unemployment plus all the marginally attached workers, people who have been put on part-time work by a non-voluntary manner. So they want full-time, but they have to take part-time because there's nothing else available. If you include them, then that new unemployment metric is at its 3-year high. When you also look at youth unemployment, that's also pretty high. And that is also at a 3-year high. So, the U6 unemployment is at 8%, and the youth unemployment is, if I have it, this is actually all going into our report for the subscribers of Bitcoin Intelligence. So I have it all ready. Youth unemployment sits at 9.7%. So we have this situation where people are not getting fired, but the young people and also the people on the sidelines and the part-time people, they have trouble actually getting hired. So again, exactly like Chair Powell said today, this is a question of where does it break? Would it end up seeping into the headline numbers of the unemployment, or does the economy moves in the improvement direction where it begins to also absorbing some of the labor availability from the underemployed pool? But there is underlying weakness in the job market. Another way you can understand this is when you look at the hours worked, that is also at its lowest value. So it's at 34.1 hours on a weekly basis. This is the absolute lowest value in the last 5 years. The last time we saw this low number of hours worked, it was at the bottom of the COVID. So essentially, again, the picture that emerges about the economy is that companies are just giving people less work. Instead of full-time, they put them on part-time. The number of hours available to work is lowering, but they're avoiding layoffs. So you don't see much of a damage to the unemployment numbers, but at the same time, there are a lot of people in pain. Similarly, when you look at the economic growth, we also don't see a really good picture. The GDP growth has declined since Q3 2024. By Q4 last year, it was at 2.3%, down from 3.1%. And that was all before this trade war effects, which will have a pretty significant effect. And when you look at the summary of economic projections that the Fed published today, they also mentioned that they have lowered their GDP growth targets, partly because of this. So the new growth numbers that we are expected to see moving forward should be significantly lower. The trade war is pretty damaging because it adds friction to the economy. And it slows down economic activity, slows down production. It makes the economy less efficient. So the longer it goes, the more damage it does to the economy. So that's another thing that might unfold in when we get the Q1 data for 2025. We should be seeing the effect of all this trade war scare and see how far we deep down the recession path. If that's pretty significant, that will motivate the Fed to basically resume cutting rates. So I really anticipate moving forward throughout this year, we get a few surprises when it comes to GDP. Now, that's also partially interesting and maybe positive because that will dampen the inflation growth. So I was pretty vocal since Trump got elected and talked about tariffs, that this will lead to inflation and that it will tank the markets. And at that time, a lot of people were like, no, this would not have any effect. Last time we had no damage in 2018 to the inflation numbers. But we were actually seeing pretty significant rise in the last several months. But the next leg of this story, the next leg of the move, is going to be down for inflation, because after you get a supply shock that pushes the prices up, that shock will slow down your economic activity, and it will move the risk moves from inflation to recession. So you initially get a shock to the prices that will dampen the morale and the sentiment and the ability to function for a lot of businesses. And then the slowdown that you get from there brings down inflation, but then increases the risk of recession. So it's not necessarily a great outcome, but pretty much by summer, if the story unfolds exactly like this, by summer we should see sharp reduction in inflation and renewed fears of recession. And that would be exactly when the Fed will come back and restart rate cuts. Okay, the other thing is consumer sentiment. Consumer sentiment is pretty down. Some of the survey data are showing that people are pretty substantially pessimistic about the future, about the job prospects, and about the inflation. But the Fed today mentioned that they don't really place too much weight on these soft data because it still hasn't showed up in the hard data. And they also mentioned that in the past, they haven't seen strong correlation between the surveys and the hard data, so they're giving it a lot less weight. Nevertheless, we do have some hard data that shows some worrying signals, which is the retail sales. The latest retail sales that we got actually showed a pretty strong slowdown, which might signal the consumer is in trouble and they're starting to run out of money, or it's the psychological effect coming from all the fear that we talked about. So that's a worrying sign. When you get negative surveys, and it also shows in the hard data, that's pretty bad. In February, we had a pretty negative retail sales reading. In January. But people were hoping that this will recover in February. The estimates were a pretty strong growth of 0.7%. Instead, we got only 0.2% growth in retail sales. So it's pretty weak. We'll see what March will bring. If that also is weak, then we have confirmed a downtrend in retail sales. So the markets are really in this shaky position where we have a lot of reasons to be bearish, some reasons to be bullish, and any new data point will actually determine a lot of what happens to the market. The Fed also today mentioned that they are now just seeing balanced risks, and they are waiting to see what the data suggests. They're not dependent on any predetermined path for the policy, and they're just waiting to see what the economy does. So that's a general macroeconomic summary. We have strong headline numbers with underlying weakness. So we have to give the data a few more months to show us what trend is actually unfolding. But confirming all this, Bitcoin itself is also showing some of these negative signs in the data. First of all, we've had our significant crash, a 30% crash, which we haven't seen in a long time, especially in this whole bull market. We haven't had big crashes. It actually has been a pretty interesting cycle where you get very small corrections, which they get bought pretty fast. But this time we actually did get a complete 30% crash, which we have been familiar with from the last cycles. And then commensurate with that, a lot of the supply and profit has come down. A lot of profit has been eroded. But right now, we still have 77% of supply and profit. So it really hasn't reset to the extent that completely eliminates the speculators. So the market can still go either way from here, depending on what macro does. And macro these days is pretty much what Trump decides to do. If he eases the tariff talk, the economy can quickly come back. Or if he continues with the tariff, especially with the April 1st deadline, we will know a lot more about how much and for how long these tariffs will last. And if they're supposed to be lasting, the economy will further crash, and it might have negative influences on Bitcoin too. And there's a lot of supply and profit, so there's still quite a bit that people can sell. The other thing that you can look at is MVRV metric. That also has not really, reset yet. It's kind of sitting in the middle of the range, and again confirms that we have a lot of unrealized profit. People have been hurt a little bit, but there's massive amount of profit left in the market. When you look at actual realized, so this was all unrealized. When you look at actual realized activity, we do see that people have been taking a lot of profit when we hit the all-time high after Trump pump. Then all that profit taking, in absence of new demand, caused the price to start sideways and then drop, as we've seen. And what we really want to see is a lot of loss realization, meaning a lot of people having to sell at a loss and panic sell, basically, which would mark the end of a crash. So if you look at prior cycles, typically the bottom of many of the crashes have coincided with massive amount of loss realization. We did get a little bit of that. Very little amount of supply was essentially, the average profit and loss turned negative for a very short amount of time, but we need some more of that to confirm a strong bottom. So it's been fine. It's been good that we see this loss realization, but we still haven't seen that panic and capitulation. So if there is negative macro events, there is still room to damage Bitcoin. Even though I think Bitcoin is well ahead of the stock market, so it will bottom way before. And it, again, all depends on what the government tries to do. The other data that we've been looking at in our latest, actually the first Bitcoin intelligence report, is the realized prices of different ages. So when you look at people that have bought in the last week, last month, last 3 months, last 6 months, a lot of the recent buyers are in pretty significant loss. So people who have bought in the last 1 month, and particularly, or actually even everyone that has bought in the last 3 months, when you look at the average purchase price or the cost basis, today's price is below that, so they are on average in loss. Now, the only cohort that is not in loss is people who have bought in longer than 3 months. But focusing on people who bought 3 to 6 months in the past, these are kind of the short-term holders that are not very short-term. So kind of the older cohort among the short-term holders. The cost basis of these people is 85. And understandably, the price is actually playing with that value as well. So these people actually are now have lost all the profit. Okay, they can do two things. Either get out because they fear that they might begin to go down into negative. in which case we will see another down leg in Bitcoin, or these people might say, might come in and buy the dip and at least stop selling because there's no profit to be taken for them. Okay, so they've taken all the profit, nothing is left. Now it all depends. So again, this puts the market in a very shaky position. In the past examples of corrections, the market has actually bounced back from the cost basis of this cohort. Okay, so last year in 2024, market went a little bit below the cost basis of this cohort, but then came back up and resumed the bull market. We had another bounce back from their cost basis in late 2023. So this is a pretty important cohort, and we are now at their cost basis. So what they do really determines what goes on. We'll have to see if this level holds and how the price bounces at this level. If it goes below it and stays below it, then it shows that this cohort is also giving up. So on-chain data, essentially, the way I see it, gives us paints a risky picture where we are kind of in this mid zone where there's a lot of damage done, but a lot of more damage could be done, and it all depends on whether new demand comes in or not. What determines the new demand? It's basically the macroeconomy. And that involves the trade war discussion, the government spending, all the layoffs they're doing, improves the productivity and efficiency, but layoff has negative effects for financial markets because it reduces the amount of money available. It reduces government spending. Government spending weakens liquidity. Less government spending weakens liquidity, and that might tank the markets further. Then we've had all the uncertainty that Trump administration has added to the market, and that has caused a lot of the international investors to move money out of the United States. You can check that by looking at how international stock markets have outperformed the US. Okay, so will that money come back? Again, it depends on when we get more clarity and certainty on the administration's policy, which is coming. I think, in my opinion, this is a temporary phase. The administration is looking for a reset. They've been very clear that they want some short-term pain, and they may not worry about some damage to the stock market. They've been very clear that it's okay to them if we get some short-term pain in the market, but they are pretty attentive. Once they achieve this phase, they will quickly change, and before we change the policy, and before we know it, the discussion will be around the tax cuts, more support for the economy, more stimulus by the Fed, and all that will be super, super positive. So that's actually why I have this V-shaped economy thesis, where I've been saying we will see a initial crash, which pretty much most of it, in my opinion, has happened. There might be another leg because we still have that macro weakness, and I'm waiting for further data in the next few months to show whether that weakness continues or stops. But we are not far off the bottom of the V, especially in Bitcoin, again, because that's going to bottom before the stock market. And once that happens, most of the bad news will be priced in, and what we will get is all the positives, right? All the positives that are expected from Trump administration, reducing the regulation, boosting the private economy. And if we do actually get that other leg and economic weakness that we see the risks of, then the Fed will also resume the cuts. Today, they have also significantly reduced the quantitative tightening, which instead of $25 billion per month of runoff. They dropped it to only $5 billion. So pretty much done. Quantitative tightening is done. And the markets like that. But I think absent a supportive fundamentals in the economy, that may not be a lasting boost. So essentially, in my opinion, everything depends. Everything, even with Bitcoin, depends on how the administration and economy moves forward. Perhaps if we see another set of data points on unemployment and inflation and growth, this will be very informative in terms of where we're going. The trade war is pretty bad, but it's important to catch when it actually gets fully priced in. So markets really will bottom way before the actual damage is done to the economy. So I think another set of data points would really clarify where we're going, but I would be very cautious at this point. Last week, I did see a pretty substantial loss realization by short-term Bitcoin holders. So I stepped in a little bit, and the market has been up from there. I stepped in at 78, catch the signal at that. The market went down to 76 and then went back up. But I'm not writing this off as the absolute bottom. I'm just waiting for more confirmation. For now, just observing the market. I guess that's all my thoughts, and we'll see what the future brings, and we'll be there to definitely react to when Bitcoin wants to move again. All right. If you have signed up for our Bitcoin Intelligence product, you will soon get our article covering the ideas that I mentioned with all the charts and details. And if you haven't, you can find it at 21stcapital.com/BI. So let me type it actually. 21st. Yes. So you can find it here. You can join us by just providing your email and first name, and you'll keep getting our analyses. So this was our first analysis for after the launch of the product. We will keep producing these on a weekly basis, and we will cover several angles, anything that affects Bitcoin in terms of, again, macro that we talked a lot today about, because it's kind of it now has the upper hand in determining where Bitcoin goes. Next, we will look at on-chain. Next, we'll look at derivatives, options, futures, and our own proprietary models. So with that, thank you guys for your attention. I have some comments, mostly thank yous, but no questions. So in that case, I'll stop here, and I'll see you in the next video.